Good afternoon, everyone. Thank you for joining us for the Canaccord Wealth Lifetime Cash Flow Planning webinar. My name's Hazel Bowen. I'm a Senior Wealth Planner at Canaccord Wealth, and I'm going to take you through the session today. It's great to see so many of you online with us. I'm sure many of you are existing clients of Canaccord, but for those who aren't, before we start, I'm going to run through a little bit about who we are and what we do. So we are a wealth planning and wealth management business, offering investment management services and financial planning services to our clients to help them achieve their goals. We're one of the largest financial planning and wealth management companies in the UK, with nearly 35 billion of assets under management, 17 offices in our region, which is across the UK and the islands, and we have nearly 800 people working in those businesses. Our role here as a firm is to help you achieve your financial goals. And we do this through offering a range of services, many of which are useful to all our clients. So you can see we offer investment management services, wealth planning, and specialist advice in relation to how to manage your money. Some of these services are useful to have on their own, and some of them are useful to have combined. And the nice thing about the way we work with our clients is that you can have whatever is useful to you so that you get a bespoke service from us. I'm your presenter today. I'm Hazel Bowen, as I said, Senior Wealth Planner at Canaccord. I'm a Chartered Fellow of the Personal Finance Society, and I've been working in financial services for 20 years and advising clients since 2011. There's a lot up there, but the most important thing that I would share with you today is actually that bottom line, talking about delivering meaningful client outcomes in a way that engages, empowers, and inspires clients. The reason I emphasize that today is because that really summarizes how cash flow planning can help with your financial planning journey. So today's agenda will be to have an introduction to lifetime cash flow planning, look at how lifetime cash flow planning can help you achieve your goals. Have a look at the lifetime cash flow planning journey in action. And then look at why it's important to review your lifetime cash flow plan and how to access that service if you're feeling inspired by the end of today. We'll take about half an hour to go through all of that. So let's start with an introduction to lifetime cash flow planning. What is it? So to put it simply, it's a projection of your expenditure over your lifetime and the income and assets that you expect to have to be able to meet that expenditure. It takes into account assumptions that we make that are reasonable around inflation, things like investment growth, life expectancy, and the idea is that it gives you a clear visual representation of what some of the financial choices you make will look like. So how does this work for you? Well, the financial planning lifetime cash flow journey starts with a conversation about your goals, your needs, your ambitions in life, not just for you, but also for your wider family and anyone else who is important to you. That conversation is the foundation for good financial planning, because the better we understand what you want to achieve and why, the better advice we can give to you. And it's the same when it comes to putting together your lifetime cash flow forecast. Once we understand your goals, we then look to try and quantify those and prioritize them. Hopefully they'll all be achievable, but if they're not, it is good to understand which of those are really most important to you. And then once we understand that, we map it out for you on a timeline so that you can visualize when things might happen and how that might work from a financial perspective. We also assess where you are now. So today is the starting point for your financial plan. What assets do you have? What income do you have? And how do you think that might change for you in the future? And as I said, we make reasonable assumptions, and some of those are based on inflation, investment performance, and some of those are more unique to you, such as if you're likely to stop work at a certain time or reduce your hours, what might your assumed future income will be when you reduce your working hours. So there's lots of things that we take into account for this to make it a really personalized forecast. So with all that information And with our professional expertise, we then put that all together in some modeling software, and we reflect back to you the outputs of those conversations visually in graph format. And that allows you to very easily understand where you are now and how you might get to where you want to be, and compare potential different options that are available to you. It's interactive, so whilst we can provide outputs in graphs, in charts and documents for you, we can also sit down side by side at the computer and you can say, well, what about if I change this? Or how about if I give this money to my child? How will that impact my plan? So lifetime cash flow planning is really about giving you ownership and giving you the opportunity to really engage with your financial planning and your wealth in a practical way, because ultimately your wealth is here to help you achieve your goals. So to summarize that, it is helping you visualize and achieve what you'd like to do in the future. And this just shows you that journey. So at the bottom corner, you have before we start planning. So we look at your current wealth, we look at your forecasted wealth. Part 2 is that scenario and solution testing. What if the markets fall? What if my partner becomes ill? What if I retire early? And there's also, some positives. What if we have a windfall of money? What if one of our children has a child and we want to support them? And we can factor all of that into the plan. Then, as I've said, point 3 here, we allow for growth, inflation, interest rates, market volatility. And ultimately, we come out the other end with a plan where through prioritizing those goals and having realistic conversations, and also through using financial planning methods to reduce your taxes and increase your returns, combined, we get you to the position where hopefully there's not a financial shortfall. And just comparing those two charts on the screen, the first chart you see, there is a block of red, and that is where you don't have enough income or assets to cover your expenditure. When you get to the second chart on the screen at point 4, you have no red in that chart, and that means you have no shortfall in your expenditure. And I'll bring this all to life for you more in the live demo. So this takes me on nicely to the live demonstration. So hopefully you can all now see a software called cash flow planning on your screens. And you will see a chart there that's broadly blue bars with some red at the end. So I'm going to run you through this, but before I do that, I'm just going to explain some of the information that we input into this to help bring it to life. So this is a completely fictional client, and I should say at this point, this is not intended to give you advice, even if your circumstances happen to be quite similar to the client who we have made up for the purposes of this cash flow. In this case, we have a couple who are both 56, keeping this quite straightforward, born on the same day. And we project this cash flow for a assumed life expectancy. And again, for simplicity, we've assumed that they both die on the same day at age 95. So this plan runs from 56 to 95 years old. The couple intend to retire at age 60. They would like to make gifts to their children. And they've come to us with a very common question, which is this realistic? Can we achieve all the goals that we'd like to achieve? So the starting point is to understand the goals and to then understand the current financial circumstances. So in this case, we've got John and Jane. They're both employed, both earning £70,000. They have current savings and investments, as you can see here, of £100,000 in savings, an unwrapped investment of £250,000, which they own jointly, and they each have an ISA also worth £250,000 each. And that's a stocks and shares ISA. They live in a property with no mortgage worth £1 million. They each have their own SIP, so their own self-invested personal pension worth £250,000. And they both expect to receive the full state pension when they get to state pension age. In this case, we've had a comprehensive conversation about what their living costs are now and what they expect them to be in the future. For the purpose of this cash flow, for simplicity, we've assumed that they require to spend £60,000 a year, so that's after tax, and that will be the same for the duration of the plan. I should stress that this is designed to keep it simple today. With many clients, we know that that's going to be quite different. You may spend more pre-retirement with other outgoings that you have. You may then spend perhaps even more early retirement to go on lots of holidays, and you may spend slightly less as time goes on. The other thing that we've allowed for in here is the potential for care fees. Now, we're going to keep this simple on our timeline, which I will show you in just a moment. We've assumed that the clients will require care for the same amount of time and at the same time in the timeline, and that will cost £75,000 each, so £150,000 per year for the two of them. We also include plan settings. So I mentioned earlier about some assumptions that are made, and this is where we put those. So for the purposes of this plan, I've assumed a long-term inflation rate of 2.5%, a savings growth rate of 1.5%, and an investment growth rate net of costs of 4%. And that's on the basis that, for this example, I've assumed they're erring on the cautious side. Now, just on those assumptions, we will usually use a standard inflation rate, a standard rate for cash, but that rate of return that we use for your investment growth would be personalized to you based on your personal risk profile. So your tolerance for risk, your need to take risk, your capacity for loss, which is something that anyone already working with a wealth planner will have sort of heard those terms, but it's all about making sure that the risk you take with an investment is right for you. So those are the inputs into this cash flow. Let's see what this is telling us. Oh, the final thing to say is that there's a gift to Jack and Jill, the two children. And in this case, so these are the girls, a gift to Jack and Jill of £150,000. And they all each, and they'd also like to have a milestone holiday for their 40-year wedding anniversary. And they want to spend £40,000 on that and do something really sort of memorable with the children. So it tells us here, first of all, that those goals can all be met. But there's something else to add to the picture, which I'll come on to in just a moment. So the next things to talk through is the timeline. We've got the plan start, and this is the pre-retirement years. They both want to retire at 60, so that sits here. And then there's a gift to Jack at age 30, a gift to Jill at age 30, and their wedding anniversary falls in between the two. In this scenario, we've assumed that the clients both go into long-term care at age 90, and that, as I said, they live to age 95. So there are various different outputs that a lifetime cash flow plan can show, including cash flow, assets, taxes, and so on. Today, our focus is going to be cash flow. So I'll explain this first. What you have is the horizontal black line running across here. And what that is the total expenditure in any given year. For the purposes of keeping this straightforward, this is done in today's money terms or real money terms. So what that means is it looks like the expenditure of £60,000 a year doesn't increase over the course of the projections. It does. There's inflation factored into this. But because it makes it more real for clients to see things in today's money, that's how we represent this. The blue bars, or the blue columns, are the inflows of income coming in or inflows of capital, depending on the situation. So in the pre-retirement years, you have their total combined earnings coming in. Then when they retire, we are not using earnings. So capital is being spent and savings are being spent, and therefore only the amount that's needed is applied. And then we have a few spikes, and you've probably worked out already that these spikes relate to those gifts and the party. When you get to the far end, the spikes up here relate to care fees. And for anyone who's wondering why this isn't a flat line, because the care fees are the same each year, and why there's this little jump here, that is because the different assets that are being used to fund the expenditure, which I can show you, impact the taxes. So at the start, you have employment income. Here, you have savings and investment income being used in the light blue. The dark blue here is state pensions coming in. And then when savings and investments have been exhausted, in this scenario, the pensions are being used. Now, because the pensions are taxable income, slightly more needs to be drawn to cover the extra taxes. And then the same applies in these years when significant funds are being drawn, just in case any of you were wondering on that detail. So just to keep it clear, I'm taking off the detail. So what does this cash flow actually tell these clients? Well, yes, as we saw on the previous screen, you can achieve all the goals, but there is a shortfall potentially later in life here, and that's what those red bars show. So where it's blue, there's enough income and assets to cover the needs, and when it's red, there's not. Now, that doesn't necessarily mean it's not appropriate for a client to take that course of action and make those gifts, but it's about awareness and understanding. And they do own a property, and potentially later in life, they could use that to fund that shortfall. So that's scenario one. We've got various scenarios here. So another one to consider is, well, that's all well and good. That's showing an average 4% return, which does allow for different increases and falls in the markets over a period of time. But what if there was a significant market crash at an unfortunate time? So if I go back to the timeline on this scenario, I'm showing you a different scenario now. Everything else remains the same, but we've added a market crash for these clients at age 59. The reason we put it in then is it's just before they start drawing from the portfolio, and therefore it's particularly unfortunate timing for these clients. Okay, and what I'm going to show you is the original one that we just saw. So at the top, you can see here, if everything runs swimmingly and there's no market crash, that's the first chart. And the bottom chart is the same, everything else is the same, except we've put in a market crash. And we've put in a market crash just so you know where the portfolio loses 25% of the value. So it's quite cautious, I suppose, cautious, negative view of what could happen, but it's very important to take these things into account. And as you can see, this red kicks in a lot earlier. So the shortfall arises at age 83 in that scenario, as opposed to age 92. So again, this is all about awareness for clients. And that's just that chart for you larger. Okay, so what can these clients do? Well, one of the things we can do, as I mentioned earlier with cash flow planning, is do scenario planning. I will show you shortly how this can be done interactively. But what I've done for the purposes of this is prepare different scenarios just to give you a flavor of the things we might talk through with clients. So scenario 3, what have we done? Well, I've suggested to these clients that they reduce the gift to each of their children to 100,000 instead of 150,000. Now, it's not our job to tell clients what to do, but it's just to put scenarios out there to explore and discuss. And in this scenario, there is still potentially a shortfall in later life, but it does push that a few more years on. So it's one way that we can look in part of addressing that potential shortfall. In this scenario, we're looking at a £100,000 gift, so still giving a reduced gift and still having the market crash. But in this scenario, we've added in a downsize to their property. And what I'll do for this is show you the details. So everything looks very similar, but what we've included is that at age 70, they downsize their property. So you may remember their home was worth £1 million. For the purposes of this, I've assumed that they downsized to a property that's worth £500,000. There's costs of £50,000, which again is probably quite a cautious approach, but worth including. So they've released £450,000 in today's money. And that assumes obviously that house prices go up. So that's what that big pink injection is here, the extra money they've released from selling their home. And what you can see is because they've got that available, and what I've put into the cash flow is that they invest it into their general account and then continue to use it to feed their ISA. That they actually push that shortfall right back so that they have enough funds to meet their lifestyle goals and cover the potential costs of care right up until age 93. And again, at this point, whilst there is a shortfall, they still have a property, albeit worth slightly less, but a property that they could use. So again, we're looking at how visually these clients are able to understand straight away the implications of different actions. And finally, I prepared one last one just to look at a different way we could explore this with a client. And this is where they keep the gifts at 150,000. So they really wanted to make sure they could gift 150,000 to each of their children. So in this case, I'll show you the different inputs. We changed their living costs. So each year they spend 55,000 instead of 60,000 pounds. And because that's over quite a long time, it all adds up and it pushes that back out. And again, we've included the downsize here. So as you can see, there's quite a lot that can be visually explained to our clients using this software. And it's very easy to compare and contrast different options. So that's if we prepare static scenarios. But I just wanted to run through what we can do if we are sitting with you in a meeting and you say, well, how about this? Okay, so in this conversation, our clients have said, well, what about if we want to spend more money? We're not sure actually if 60,000 is going to be quite right. So we can, in a live environment, change this to, let's say, 80,000 pounds. And you can see straight away that it's potentially going to be unrealistic unless they make other changes, perhaps increase the risk that they're taking, although there could be reasons why that's not a good idea, or make no gifts, for example. So that's quite a telling piece of information for them to say, actually, that's probably unrealistic right now. The other thing we could do is, take that the other way and say, well, what if we changed it to 50,000? And that makes their money, as you would expect, last a lot longer. It makes the plan look even healthier than it had done before. So that's just one example of, as you can see, the way we can change this in a live environment. I'll just pop that back to the original amount. So just to show you some other features, as well as being able to compare plans, you can also have a look at two charts in this at the same time. So what we've got up the top there is the cash flow that you've seen before. And in this is the first scenario where they don't downsize, and this is their assets. So this is quite useful. You can see the property, which is non-liquid assets, running along the bottom, shown in real money terms, so therefore staying at 1 million. Then you have their other assets here. So you can see that pensions is in green, investments is in dark blue, and savings is in pink. And what this tells us, and you can see the two line up, at the end of year age 91, they've just got a little bit of liquid assets available, so a little bit of pensions available. The rest is in their home, and that's why the shortfall begins the following year in terms of their cash flow. So that's just quite a useful thing that we can show to clients. Now, there's a few other features which I'm going to run through, and I'm going to choose scenario 2 for this, which is some insight functions. So as well as being able to build specific scenarios for you, we can also look for insights that it can tell us directly. A very useful one is investment returns. And what this is designed to do is say, okay, well, what rate of return would you need on your investments to be able to achieve all those goals and not have a shortfall within the term of the plan? And in this case, the required rate of return is 6.64%. That compares to the 4% that we had been using. So again, that's a useful piece of information for your financial planning conversation. Another insight that's quite helpful is retirement spending, where we can show to our clients, excluding those goals, what would be a realistic amount to spend if you just spent your money on yourselves to fund your lifestyle. So as you can see, the gifts are not there, the party is not there. And in this scenario, if there was a market crash and they weren't downsizing, then they could spend £61,000 a year. So again, that's a really helpful way of just bringing this all to life for our clients. Hopefully that demonstration of cash flow planning brought to life some of the things I explained earlier. And as you can see, because it's very much a visual process and a journey that is evolving around your life, as opposed to looking at financial products specifically, it's a great way to facilitate conversations as couples, or if you want to get family involved in thinking about finances as a way to live your best life. So whilst thinking about the initial financial plan is really important, it's also very important to keep your plans on track. So we've spoken about and focused on so far this initial journey, which is having your lifetime cash flow planning review and with your wealth planner, looking at those needs, goals, and ambitions, quantifying and prioritizing those to get to the point of having your strategic plan. And that's where we bring in our professional expertise, because cash flow planning cannot give the technical advice. It can't say whether you should use a pension. It doesn't say whether you should use certain other tax structures or if a trust would be right for you. It shows you concepts sort of visually and in a broad brush sense. So this is where, with the cash flow as the starting point and your professional advice in terms of all of those different aspects I've just covered, come together so that you can have your strategy and you can visualize that strategy. We can implement that strategy and hopefully, life will run swimmingly. But if for whatever reason something changes, as we say, good or bad, then you may need to adjust your plans. So in that case, and it's always very sensible to revisit your planning and revise the plan. And what we would do with our clients typically is we would review things on a yearly basis, so that if anything's changed in the financial backdrop, or if anything's changed for you or your family, we can factor that in. And that's why I say on here, it's not about the plan, but about the planning. Because the plan will change. If you commit to the planning, you will always be able to stay on top of achieving what's important to you at that point in time. So if that has inspired you to have a look at your own financial lifetime cash flow planning, then please do get in touch with your current Canaccord investment manager, and they can put you in touch with one of the wealth planners we have across the country. Or if you are not already working with us, please do feel free to give me a call. My contact details are on there, or send me an email, and I'd be very happy to talk you through how financial cash flow planning can help you. You'll be in good hands with us as an award-winning firm across the areas of work we do. And the final thing for me to therefore say is thank you very much for your time today. I hope you found this useful, and have a great day.